The cost of money. Have you ever heard someone use the term before, money's cheap or money's expensive? What this essentially means is they're talking about the cost of the money being the interest rate. So when we saw rates around 2 to 3%, I used to hear the term quite often. People would say money is cheap, essentially meaning you can get money for close to zero or nothing. And now we've gone back to what most people are calling expensive money, but really it's more of the long-term average where we're at the moment. So interest rates are basically the cost that you pay to get that money from your lender or the bank. So why would you take on a high interest rate or a expensive debt, expensive money? So a lot of people do this for short-term projects, so they do this for things like flips and development funding. And with, say, flips, a lot of the time you actually go and get the money from second-tier lenders or asset lenders because the main banks don't like to fund flips. So you might go to a second-tier lender and pay a premium rate of, say, 3 or 4% higher than what the main banks might be offering you at the time. So that would be expensive money, whereas cheap money might be the bank rate. So you go to the bank and you get a 2-year fixed term at 4%. That would be considered cheap money. So what happens when we have lots of cheap money in the system and interest rates are low? Liquidity becomes easy, credit becomes easy, and lots of people go out and try to get cheap money to do projects and buy properties, which what we saw post-COVID is we end up having a property boom.